Hey, it's Mark from Caliber Home Loans. It is Friday, August 28th, and the end of just about the end of another month. It's been a brutal week, as usually the last week of every month is. I'm sure it's been very busy for everybody trying to get closings done before the end of the month, especially since next week or the week after is the holidays. So everybody's scrambling to get the closings in. So let's go ahead and take a look at the market. So the graph you're seeing is for today. So the price looks, went up a little bit from where it opened up, but the spread is pretty nominal, 4.9 versus just under 5.1. So rates didn't really do much at all today. There was no intraday rate change. So let's take a look at the week. The week was kind of all over the map, as you can see. So Thursday, the GDP and the jobless claims came out. The jobless claims were about where expected, right around a million new jobless claims. And the GDP actually was down a little bit less than expected. It was down 31.7 versus 32.5. And earlier in the week, the new housing starts actually were up, higher than expected. So that's why you see that little bump at the beginning of the week. But all in all, we're closing just about where we started for the week. So a lot of turmoil during the week, but it all evens out. And then for the last month, we're just a hair. Pricing is just a hair higher than where we were a month ago. And remember that as the price goes up, the yield goes down. But again, you got to look at the spread. So the spread is pretty nominal. So it started at 4.854, and we're going to close at 5.065. So again, pretty nominal. It looks worse than it is. And since March, again, we're going to look at since March and when the Fed started buying bonds, the trend is still, especially over the last few weeks, the trend is still for pricing to be on the rise. So that puts downward pressure on rates. So that's good news for rates. We don't expect to see a whole lot going on with rates anytime soon. The FHFA, when they came out with last week with the news that they were going to tack on a half a point fee on refis, kind of shook the market up a little bit. It caused lenders to raise rates artificially because they were going to have to pay money that they weren't collecting from borrowers. So the FHFA and Fannie and Freddie have decided they're going to push this off from September 1st to December 1st. So they're still going to charge the fee, which is still a tax as far as we look at it, and a fee that's really not needed. But at least the lenders are off the hook for paying for fees that we're not collecting from borrowers. So it gives us a chance to build that into the rates moving forward. I'm not exactly sure when we're going to incorporate that back in. But any loan we deliver to Fannie Mae or Freddie Mac as of December 1st, there's an extra half a point of the mortgage amount, 0.5% of the mortgage amount that's going to be tacked on to the overall fees. So next week is Jobs Week. So as always, Jobs Week, you've got the ADP employment, and so the expectation is for 900,000. New jobs in the ADP realm, and we've got the weekly jobless claims, and they're looking at another million added to the jobless claims. And then we've got on Friday, the big number, the employment. The employment number, we expect unemployment to be 9.8 payrolls, up 1.4 million. So this is a big driver, and it'll be next Friday. So we'll have to see how that plays out. But as I've been saying since March, at the end of the day, the Fed is just pouring millions and millions of dollars into the market. So just to keep rates somewhat stable. So we'll have to see what happens. I don't expect rates to really move around too much. So the finance, the half-point finance fee has taken its toll. It's pretty much baked in, or it's going to be baked in, so I'm not too much worried about that. Purchase applications are just off the hook. sales are off the hook, and at least in our part of the world, houses just don't stay in the market very long at all. So it's a great time to buy. Rates are still super low. I'm still quoting under 3% on a 30-year purchase. With great credit and everything else being involved. But so it's if people are thinking about moving, it's still a good time to move. And if people haven't refinanced, they should refinance before this half point gets baked back into the rates. So anything I can do for you, give me a call, 248-705-8431. Thanks a lot, and have a great weekend.